Hey there, crypto enthusiasts and market observers. Welcome back to Key to Crypto, or KTC. In today's video, we'll be diving deep into Mark Yusko's insights on the current Bitcoin news and updates. Travel back to 2018 with Yusko, a time when Bitcoin was a mere $6,700, and the journey to convince institutional clients to hop on the crypto train began. Oh, the skepticism. You're an idiot, they said. Fast forward to 1415. Wait, no, not a time machine malfunction, but the early days of 2014 and 2015, where our attempts to enlighten them faced a similar response. Don't talk about that. It's just stupid. The message then and now? It's time to break free from zero, guys. Brace yourselves, for this movement is not just a trend. It's a seismic shift, a tidal wave of people, volume, and value. And guess what? It's only getting started. The law of large numbers is at play here, each wave larger and more powerful than the last. So, why not ride the crypto wave with us? Join the movement because, according to the United States Securities and Exchange Commission, SEC filings, Fidelity, the financial giant, is diving into the crypto ETF game. In a proposal reminiscent of their Bitcoin ETF pitch, Fidelity is vying for approval to list a spot Ether ETF. Notably, they're leveraging the recent Grayscale case as a precedent where the SEC faced criticism for lacking a clear rationale in rejecting spot crypto ETFs. Grayscale, in a David versus Goliath move, took the SEC to court and emerged victorious, with an appeals court demanding a review of their rejected Bitcoin ETF application. The clock is ticking, and according to the optimistic Mark Yusko, we have just 6 weeks until the grand liquidity pump, potentially signaling the start of a bullish market. His advice? Get ready. The crypto landscape is about to experience a seismic shift, and you don't want to miss the ride. Now, let's dive into the details and hear Mark Yusko's insights in this video. Brace yourselves, guys, because the floodgates are about to open. Yes, you heard it right. Everybody is jumping on the crypto bandwagon, and January's first weeks are set to kick off with a bang at our London event. Hold on to your hats, as the BlackRock ETF approval is on the horizon. And we're not talking millions, but hundreds of billions of dollars flowing into Bitcoin. Get ready for a domino effect, transforming the digital age landscape. The countdown has begun, marking just 6 weeks until the initiation of a groundbreaking 14-year tech cycle with blockchain at its epicenter. The excitement is palpable, and at a recent New York conference, we couldn't help but share our optimism. Picture this: Bitcoin potentially becoming the base settlement layer for all global assets. Now, we didn't say it's a done deal, but there's a chance, a real chance, as per Mark Yusko. Let's dive into the nitty-gritty. The highest quality assets are eyeing Bitcoin as their migration destination, making it the ultimate settlement layer. Quality? Think uptime, security, and a lack of hacks. Now, the ETH heads might debate about transaction volumes on Ethereum, but the focus is on Bitcoin's prowess as the ultimate digital gold. It's the better form, equally scarce, more divisible, and more portable. The abstraction game can continue, but the fact remains: Bitcoin is making its mark. However, this journey won't be without its battles. Market sentiments may suggest that the Federal Reserve's anti-inflation rate hikes are in the rearview mirror, but not everyone is convinced. Susan Collins, president of the Federal Reserve Bank of Boston, acknowledges the encouraging data on cooling inflation, but refuses to rule out traditional firming. Patience and resilience are key, she says. Mark Yusko, the maestro of macro, is unraveling the intricate dynamic between rate cuts, inflation, and interest rate hikes. Let's embark on a journey into the macro cosmos, a topic we've been dissecting for a solid while now. Buckle up, because what you thought was inflation might just be a curtain raiser for currency devaluation, the real star of the show. The narrative has been tangled, with oil prices rising and the supply chain playing havoc, all orchestrated by a symphony of questionable policy decisions. Fast forward, and we find ourselves back where it all began. Yet, the market's jubilation is akin to celebrating newfound treasures. Hold your horses. It's not a sudden surge of good news, but what was once the November effect, formerly the January effect. The market dance isn't a Santa Claus miracle. It's the aftermath of real folks shedding their financial baggage in October and patiently waiting for 30 days before diving back in. The short sellers, much like those caught off guard by the Bitcoin rally, got their fingers burned, adding fuel to the November surge. We're up over 10% in November in the equity markets. And here's the scoop. It's not the jolly old Saint Nick effect. It's the consequence of real players making real moves. And guess what? It's tied to tax losses, not the North Pole. Now, let's talk inflation. Professor Plum, aka Mike Green, has a reality check for the inflation fearmongers. A 3% figure doesn't mean prices aren't rising, they're just rising less than before. Inflation doomsayers might want to brush up on Economics 101. The working age population growth is on a downward spiral, heading towards sub 1%. Boomers are gracefully aging, turning 65 by the thousands. Yusko vehemently disagrees with the notion of inflation soaring into high single digits. Brace yourselves for a deflationary environment, not an inflationary extravaganza. The 2% inflation target? Yusko deems it a mere theft target, driven by the deceptive concept of increasing the money supply to devalue the currency. Cue the eye rolls as expectations lag behind reality, shocked that, surprise, surprise, printing loads of money results in higher prices. Yusko punctuates the point. His house didn't magically become more valuable. The money just got worse. For the first time in a century, they're tightening the money supply, ushering in an era of negative money supply growth. Hold tight. The macro ride is far from over. Bitcoin whales have been orchestrating a symphony of accumulation since the dawn of 2023, orchestrating a crypto crescendo that has swelled the coffers of addresses holding over 1,000 Bitcoin to a whopping 7.66 million Bitcoin. It's a whale of a tale, and these behemoths show no signs of slowing down their crypto hoarding spree. The Federal Reserve's conspicuous silence on updates regarding cryptocurrency regulations has become a source of growing apprehension within the financial landscape. This vacuum of official communication has created an environment where concerns are proliferating, with many stakeholders eagerly awaiting clarity on the regulatory path that cryptocurrencies will tread. Vice Chairman for Supervision, Michael Barham, decided to break the silence, unleashing some rather candid comments on the crypto market. His spotlight turned to stablecoins, labeling them as historically explosive when left unbridled by regulation. Stablecoins, due to their pegged nature, are intended to maintain a stable value by being backed by reserves or other assets. However, the absence of stringent regulation could potentially lead to volatility and risks that, in Barham's view, have historical precedence. The label explosive suggests a level of unpredictability and potential for market disruptions when these digital assets are not subject to regulatory oversight. Barham's comments highlight the regulatory dilemma surrounding stablecoins. On one hand, there is a recognition of the need for innovation within the cryptocurrency space, including the development and use of stablecoins. On the other hand, there is a call for a regulatory framework that provides clear guidelines and safeguards to mitigate risks associated with their potential. Barham dived into the debate on whether stablecoins should be integral to the blockchain adoption journey. His take? Allow stablecoin innovation to flourish, but only if it navigates within the tightest guardrails. The crypto market's volatility and recent roller coaster rides, according to Barham, haven't deeply entwined with the banking system. Most banks, adopting a cautious tango, are steering clear of substantial exposure to these digital assets. Despite the Federal Reserve's regulatory poker face, the need for crypto regulation echoes through the corridors of uncertainty. Crypto investors, on the other hand, seem unperturbed, maintaining an air of optimism that could rival even the sunniest of forecasts. As we gaze into the future, the spotlight gleams on the highly anticipated approval of spot Bitcoin exchange-traded funds, earmarked for January of the upcoming year. The anticipation of this regulatory nod has been a bullish tonic for Bitcoin, a fact not lost on the whales who continue to seize the opportunity with fervor. Over the past 11 months, these colossal addresses have amassed a staggering 120,000 Bitcoin, a treasure trove now valued at over $432 billion. With Bitcoin's price poised for a potential rally, these savvy investors might be on the brink of reaping significant profits from their year-long accumulation saga. Do you align with the 6-week bull run prophecy of the Oracle, Mark Yusko? Share your crypto insights in the comment section below. That's it for now. If you liked today's video, don't forget to leave a like and subscribe. Until next time, and remember, the future of finance is here with KTC.